Good morning. I hope you guys doing well and welcome to today's edition of the London Session Open. Today is March 14, 2019 and it's 30 minutes past 9 a.m. in London where I'm based. Going to take a look at the markets as we usually do and also sort of answer any questions you may have about, euro dollar, GBP or any other market you have an interest in. And these webinars are brought to you by ATFX as well, which is a London-based broker with offices in London, Dubai, Hong Kong, and yep, that's it. I think actually, there's more offices when I think about it. Vietnam, they just opened, and Malaysia and places like that. So if you have any questions, you want to get to know either the London branch or any of sort of local offices close to where you are, just let me know. We do offer some very, very tight spreads and also some services as coaching, one-on-one coaching to new clients and other educational content as well. Now, let's begin. And we're going to begin with the euro, as we usually do. And the euro is not doing too much. It's now traded above that ECB rate meeting high, which was at 113.20-ish. So the breakout here that I was working with is now out the window. We're definitely not. This was definitely a false breakout, the way I look at it right now. And as I said to you over the last few days, I actually shorted a bit on Friday at 112.30, and then when the non-farm payrolls numbers were out, and as bad as they were, I closed out at 112.40. So I closed out for a 10 pip loss because the numbers were so bad that I thought that we were gonna go all the way up to the high and on Friday, and we went all the way to the high, but obviously a few days later. Now, looking at this right now, we're stuck in a range here, guys, and there's very little we can do. And yeah, I think we can literally just being stuck here. So I don't have a strong view. And this is the dollar index, sort of telling us the same thing. This is obviously an aggregate euro dollar, a bit of GBP, dollar yen, New Zealand dollar, I think as well, and a bunch of other things like Swedish kroner. And you can clearly see here that we're clearly stuck in a range. So again, there's no point trying to buy or sell the dollar here, because when something is trending sideways like this, no one really knows what's going to happen. And the best trick is to let everybody else figure out. So if the market takes out the highs, we turn bullish. If the market takes out the low, we turn bearish. As for the euro, what I still prefer, and I think from a macroeconomic perspective, is this little break here. So take out 1175, then I'm probably going to sell there. Probably going to turn bearish and short. So that is what I'm looking for. And that's it really. Until that happens, I'm not touching this. GBP versus the USD. New weekly high. We took out the March 12 high yesterday. Why? Because it looks like we're going to have a delay in Brexit, and the EU has been quite clear that they're willing to give the UK the ability to delay Brexit if there's a reason like a second EU referendum, maybe general election, or something totally different. They just don't want to go back and do what has been done lately because it's not really getting nowhere. We'll see what happens, and it all hinges on the PMs to vote for that this evening. The evening before, yesterday that is, the PMs decided to vote against a hard Brexit. But if they don't vote for the extension today, then hard Brexit is the default. I'm not really sure what people want. I'm not sure if this is going to solve anything, but it definitely looks like we're going to have a bit of a delay. And the market is cheering this because they anticipate, well, we're probably going to get something softer going forward and not harder Brexit. And a softer Brexit is better for the economy, and that is why GBP, the British pound, is going upwards. Okay, so here I can say that we have a bit of a bullish bias. This bullish bias we've been working on lately, sort of, is in play, and it might be we'll go down and then we go upwards. So really around this level and this level here, I think people are going to be looking to buy. And if we get the delay, which is highly anticipated, I don't really think we're going to have a major move, but again, sort of probably going upwards. What's going to happen afterwards is how the debate forms after the vote on the extension. If they vote for to do that, the vote for no extension, GBP/USD is going to be journeying down here. And as we are at it, let's take a look at GBP/USD. So this is GBP/USD, and the market here is still deviating away from this multi-month year range, actually multi-year range. So this is the range that was dominating before, and we had the break here on February 26th, and then it's been a very, very messy one. We did spike above the breakout candle here. This was like this, especially when you trade political events, but we're still in a downtrend. Looks to me that we can probably continue to trade lower Euro GBP/USD. It's just because the market is pricing in, from an economical perspective, a softer Brexit. Dollar versus the Japanese yen is finally catching up with stock markets. We talked about it, how the S&P is much higher, the Nasdaq is much higher, even the German DAX is up. But more importantly, the US stock markets are up. So the S&P 500 should catch up. The same way as it was slow and moving lower, it's been slow to catch up, but it's going upwards. So if you're holding on to this one, congrats. You should be up with a few pips here. And I think 43 pips. And I think this can probably continue to go upwards. If it takes out the high, that would not surprise me. When and if we take out that high, the new trend of funding level is going to be this low, which is at 110.73. Gold prices moving down from the sell zone. This is the sell zone I projected. I was not very confident in this sell zone, but with the market is moving away, I say I wasn't really confident, but this is the interesting thing. The market will always, we never know for certain the outcome of the next trade. We never know, and to be honest, I never really feel very confident in this, but I have confidence in the system, and that's what we need to develop, and that's the more difficult thing, to have the confidence in the system that you're using. And the way to develop confidence in the system is to have traded it, and sort of understanding it. So more important, you need to have done some proper back testing. So you need to know, if I do this for 100 trades, am I going to be in profit or not? That's sort of the key question you need to ask yourself. And what's the risk of ruin during these 100 trades? Am I going to almost lose all my money? What did I risk over these 100 trades versus what did I produce? So if you risked 20% of your money, but then made a profit of 20%, well, that's okay. But what if you made 40% return and you risked 20% of your money? Then that's better. But more importantly, how does this? So you have these 100 trades. What happens after another 100 trades? For example, you do 20% drawdown, and then you end up at a 20% plus for the year. If you on the second year again do a 20% pullback and then go up with another 20 or 40, so you end plus 40, then that is also good. So let me show you what I mean here. There are different ways of looking at it. Certainly, we turned very educational. I hope you will enjoy this. So, for example, you start, this is profit, this is T for time. Okay, after 100 trades, is it going like this? Obviously not in a straight line, but if it goes upwards, then usually good. Now, what I was referring to earlier here is that what if you go up like this, where your drawdown is pretty much the same as your gain? That's usually not good, because it could equally have ended here than here. So what you're looking for most of the time is you're looking for something like this, maybe 2 steps forward, 1 step back, 2 steps forward, 1 step back. You can do something like this, and that's good. That's what you're looking for. And if you're working with a new system, the only way you're sort of gonna know if it makes sense is to look at historical examples. You can look manually, just looking at your chart, or you can try to code it. Most people don't know how to code. I don't know how to code, and most systems are too complicated to code anyway. So I just look at historical examples. If I ever find like a guru or someone telling me, look, this is my trading system and this, and this, then I say, okay, so do you have data for a year or two? That is really what I'm looking for. In my job here as the chief global strategist of ATFX, but also in my past job where I was the head of the London office of FXCM and Daily FX, I met many people, thousands of people, and there was always someone that had a very good spell of 3 months, uh, and but those 3 months doesn't mean anything. Ideally, you have 2 years of data, and if they can't present 2 years of data where you see the drawdown and the profit over the period, then it's usually not well listening to, because you speak with them, they're definitely going to tell you that they're the best, but a lot of people don't understand the importance of time and sample size. If you do try to ever raise money from family office or any professional investors, they're just going to look at your stuff if you're very good friends with them, and they will usually only invest if you have about 2 years of data. Anybody else is sort of just might as well buy a lottery ticket. So here, definitely bearish from a system point of view, and the system for now looks to be proving right. It could easily swing back up, though. You need to understand that. But the way this setup is constructed is that the potential profit is 1.5 times bigger than the actual potential loss. So when this goes down, up, and then down, so I would take the stop loss and pushing it lower. Okay. And this actually brings me to another little interesting topic. Most of the setups I'll share with you guys here are from my short-term system. Now, what's interesting here, if I get the right entry, like here, if this is actually the high, and I can eventually lower my stop loss, then for this specific setup, if we actually hit the target, this is going to be a 8.19 risk-reward ratio trade, because I only risked this little section here, which is $3.85 if this is actually the high. So most of the time when I get it right, sometimes I'm going to lose the whole thing, and then most of the time, at least half the time, I've done a little bit more. I can reduce the stop loss maybe by half or by significantly more. So the average stop loss is not here like a full 1 unit of risk. I think it's something like here. So 60% of that risk. So when I do it like this, if I don't actually touch the take profit level, then you will be getting slightly higher risk-reward ratios than 1-to-1, and in this case closer to 2.41. So that is something really important to remember. The initial risk-reward ratio needs to be at least 1.5 when you're trading like we're doing here. If you're trading more short-term, maybe 1-to-1. But what's interesting is that if you actually know what you're doing, the effective and after trade average profit to average loss is going to be better, because you're always able to, not always, but most of the time you're able to reduce the stop loss. Crude oil prices trading upwards. The idea was to turn bullish here, and I said the initial stop loss probably placed here at 56.24, and here the initial risk-reward ratio is 2 times. But again, the same system applies here. I think we can easily go down and upwards, but I think we can probably reduce the trend of funding level a tiny bit now. So we're suddenly at 2.84 if we actually reach target. And again, if we go down and upwards, at one point I'll be able to put the stop loss almost at break even. Okay, and that's my target. Usually I'm going to look for trades. I want to be able to put them at break even within the next few days, if possible. And then, if I get a profit, I get a profit. If I don't get a profit, it's usually like a small loss or break-even trade. Here's the S&P. Now, the S&P doesn't matter what we think about the macroeconomic economy or the economy. The markets, they lead us just many times. They lead us on the way down and they lead us on the way up. And right now, it's more of the stock market is leading with maybe a month or so. What's interesting is that, industrial production across the world was, following the strong decline, we saw weakness in those numbers. But if you look at Eurozone industrial production, it had like the best growth we had in a while for the last month's reading. And the year-on-year growth, which was negative, is now starting to turn upwards again. Let's see if I can actually find that. Industrial production for a country like the EU that exports a lot is key and paramount. It has a high correlation to GDP. So the last reading here on the year-on-year growth change was minus 1.1. So you can see how we have that strong decline, and it looks like this is the number for January. So the economic data, in essence, just decline in tandem with the stock markets. And now when the stock markets are upwards, and again, I think this is just January data, so this is lag with 2 months. Most likely, the way the stock markets are looking at right now, they're telling you, well, we're going to be positive in the next month. So we're bouncing back up here. So a lot of the sort of fear that we had, oh, we're heading into a recession, and guys, I got sucked into that as well. It's not really playing out. In my presentations as well, I did share with you guys this setup here, and I did trade a similar setup in the TSX 30, the Canadian stock market. I shorted here and made some decent profit on it. So I shorted on the bad news, made some money on the bad news, but then of course on the way up, I was still positioned, like trend-wise, the trend was still bearish, so I was positioned for lower markets. And now the way things are looking, the market moved all the way up, and not only that, the economic data is now suddenly improving. So we're not in that space anymore. And of course, we're gonna have some recession at one point. We should never ever forget that. But that's why we have stop loss orders. So for a bullish view on the S&P 500, I think if we take out yesterday's high, we're probably going to move upwards. And I'm guessing that most people are happy to remain long as long as trade above 27.80. Here the residual ratio is about 2.87 at the initial. Not sure we're going to go all the way up to the 2018th high in one go, but we're definitely probably going to go upwards. And then the key is maybe reduce the risk by 0.5% or half the amount. So yes, I'm bullish. Things can go upwards. And, we had a few setups as well that we shared the upside, but now it looks like we took out these major levels. So it looks like move more to the upside. And the same thing applies here for the German DAX. As you know, I've been talking about buying here. In fact, I talked about buying here already in January. And again, the data here in stock markets are, the stock markets are leading data with a month or so. So listening to all the doomsayers, it's not going to be helpful. But as traders and investors, we can try to trade with the flow. We'll see how far it goes. And then we just deal with stop loss orders. Now here, for example, in the German DAX, the initial stop loss has been at 11,392 for quite a long time. And when and if we take out the high here at 11,686, I think people will buy a bit more. And I think at that point, most likely the stop trend finding level goes all the way to today's low when we have that breakout, most likely. And here I'm bullish, and I continue to be bullish because we're dealing with a inverse head and shoulders with a head and left and right shoulder. Yeah, I think that's pretty much it. So we covered all the main markets here, talked a bit about industrial production and how that links well with the market, and how we've been tricked. Really, we've been tricked, and we need to pay attention because a lot of people They look at stock market prices, so they look at macroeconomics, and then they try to make sense of where the economy should be or where the stock market is. If you like this kind of stuff, if you have questions, just ask me right now. Let's see here what they say. So Vincenzo says, could we have a look at GBP crosses? And then Vincenzo says mechanical trading is always the best. And he says money management makes a difference. Yeah, definitely. The trade system, mechanical trading, just always following a system, like writing it in hard code. Uh, that's ideal, right? Imagine you could just do your strategy once and then you just put it in the system and then the system will trade for you. Obviously, it's a bit difficult. I think I haven't really been able to find anybody that can usually do that. And the reason for it is that there's so much information I take into account when I look into taking a position. But what is interesting is this. I do have a system and some sort of tactics for entries, stop loss, and take profit, and money management. You want to have all those four legs covered. So you know exactly where you're going to buy, where you're going to put your stop loss, where you're going to take a profit, and how much to risk. If you have that covered, have that written down, you have that back tested, so you know that it works, then trading becomes less stressful, and it's just about, again, following the system. This is really, really important. A lot of people don't have that, and that's why they usually lose money. And then the other layer comes the money management. Now, like everything in life, all systems, like all markets, they're gonna go. The idea that they're supposed to sort of come up here to the treasure. Well, you build your treasure on the way, right? But the key point here is that most systems, they have good times, and they have bad times, and then they have good times, and they have bad times. Over time, it's like this, and sometimes they do like this, and sometimes they do like that. Okay. Now, the important thing here is the money management as well. It doesn't matter. There's no system that is right 100% of the time. The only one that I think was 100% of the time was Bernie Madoff. And Bernie Madoff was that guy, New York hedge fund manager that scammed, I think, the Steven Spielberg and a bunch of people in the US. And he lost billions of money. His trading account looked like that. It was just crazy. There was like no variation. And obviously everybody, like even the big producers and big movie makers and everybody, they were like, oh, wow, this is interesting. I want to trade this. I want to have this because it's so nice and settled. But guys, life is not like that. Trading isn't like that. Trading is something like this. So the key point here I'm trying to make is that the key point I'm trying to make here is that the money management is here. The money management, if we trade with too much risk here, then say you risk 5% of your money per trade, then these trades could be maybe 10 trades, right? So 10 multiplied by 5, that's 50. Now, some people, they're happy to have a 50% drawdown, okay? So they're cool with that, but a lot of people are not. The problem is with a 50% drawdown is that you need to make 100% to go back to this level here. So this is where the money management comes in. In my case, I try to risk myself to 1.5 times, 1.5 times percent of my capital, and that's it really. Because then I know I have these drawdowns. Then they're gonna be contained. Most professionals that manage a lot of money, they go like a half a percent, because what they want to be up with 10-15% per year with not too much of a drawdown. So most people are somewhere here. As soon as you start to go too much, like 2%, 3%, 4%, you're literally playing with fire. And this is, again, it's a mistake that a lot of people do. Okay, we're going to wrap things up. Guys, thanks so much for watching. And if you have any questions, if you want me to help you develop your own trading system, then that is something we offer. I can help you with your trading system, give you input on that. If you have no trading system, I can help you devise one guide you down the right path. And it's part of becoming a client of ATFX. Firstly, they have probably best in spreads across many different pairs. And as long as you open an Edge account, you get access to two 30-minute sessions with me. The first session is just to get to know you. We'll do via Skype so we can share screens and things like that. And then the second is I'll follow up with you. So if you tell me I have no system, then I'll probably gonna step away, think about things, and maybe send you a few links to guide you in the right direction. And then we have a follow-up meeting where we can talk. We have, of course, even higher tier levels if you want like continuous education, which we can discuss. But the Edge account right now, you can have access to that for a small amount of $5,000. And usually it's £5,000 or €5,000. But if you come via me, then I have negotiated and talked with the guy, the head of sales at ATFX, and we can give you the Edge account, which is called of the equivalent of 5,000. So you don't have to put £5,000. It's actually enough to put something like 4,000 something, whatever $5,000 turns into. And here's the Edge account. You click down here, and you can see about the spreads. And they have very competitive spreads. I was doing a quick comparison, and on the Edge account, the spreads on GBP USD and GBP Yen were actually much tighter than many of the big brokers like FXCM, CMC, and IG Markets. And the cool thing here is that they're not only tight for the Forex majors, they're actually tight on all the Forex miners, and they're also tight on the exotics, and they're literally tight on everything here. So you can get some substantial sort of savings. So you want to check this out. About the company itself, they're regulated in the UK, they're regulated in Hong Kong, they're regulated as well in the Emirates. And we have offices in all these three locations. In mainland China, they have about, I think they employ maybe 200 people. So they're very big in that region. And now they're trying to, they're making big things here in Europe as well. The team here, the local team here, have all worked for prior FCA regulated brokers, and they're all highly experienced people. So, for example, the head of the UK team here used to be with GKFX, and then we have my colleague David Berg that used to work for eToro. So everybody's coming from experienced places. In my case, as you know, coming from Amana and FXCM. So everybody's coming from somewhere well respected. And we're here to serve you with any of your help that you may need in regards to training. Okay, gonna wrap things up. Guys, thank you so much for watching. Vincenzo, thank you so much for being in the chat, and everybody else watching. If you have questions, check out the chat, alejandro.zambrano@atfx.com. That's how you can get hold of me. You can also reach out to me via Twitter at AlexFX00. That's AlexFX00. Thanks so much for watching, and bye-bye.